All right. Good morning, everybody. Thank you for joining us today for our economic outlook. This is about leaning in and navigating uncertainty. So today we're going to talk about some of the things that our clients have been asking us. And to get started, I will introduce myself. My name is Rachel Bubb. I'm a wealth manager and CFP here at KWB. And we're going to share a little fun fact too. So my fun fact is I have two different sized pupils due to a tennis accident in high school. Steve, why don't you take it away?
Hi, I'm Steve Gormley. I'm the Director of Portfolio Management here for KWB Wealth. Fun fact about me is that I am a member of my high school athletic Hall of Fame.
Great. And I'm Kerry Bubb. I'm the founder of KWB Wealth and looking forward to our presentation today. And a fun fact about me is I'm planning to go on a motorcycle adventure in May in Spain with, I guess, 10 other old guys like me. So it'll be a nice little trip. So today what we really wanted to do is just kind of get in a conversation about some of the things that we've been getting a lot of, I guess, questions about, and people looking for information about some of the things that have been going on more recently. And of course, you'd have to have your head in the sand not to see things coming up about inflation. You know, inflation really started to rear its ugly head back sometime in the middle part of 2021, and then got more aggressive since then. So Rachel, why don't you tell us a little bit about inflation and why the government is so concerned about it?
Yes, so the government cares about inflation because the increased cost of goods affects those who are on a fixed income, like retirees, or those in the lower income brackets more disproportionately. It also makes it challenging for businesses and corporations and even the government to plan out projects. If the cost of goods is unpredictable, they can't, determine how much the project will cost, the cash flow that they need, and even the revenue that they could generate. We also don't want a hyperinflationary environment, and that's kind of what we've been having the past year or so. And the reason we don't want that is because it pushes purchases forward. So I might need a car in the next year or so, but if I'm seeing car prices go up the way they've been going, I might decide to make that purchase today as opposed to next year. So that just stimulates our economy today. However, we don't like a deflationary environment because then all of a sudden the spending slows down, and I might delay a purchase because I want to see it continue to go down. Like, oh, well, it might go down more, so I'll buy that car in the next 6 months or so. And the government doesn't know how to get out of a deflationary environment. This is a pretty sticky situation to be in, and it overall hurts our growth. So that's where we've landed on the desire of a 2% average annual inflation rate. This is sustainable, it's predictable, and we get steady growth. However, where we've been has been a little bit different. So in this chart, you can see that in November 2021, inflation creeped up to about 6.8%. And it peaked in June at 9.1% in 2022. And these different bars in the chart, the different colors represent different sectors. So you can see that at the bottom, the dark blue represents shelter, and shelter has steadily increased the cost of it. And then energy is the green bar. And we saw everybody's talking about their gas bill now, and energy has gone up because partly due to the war in Russia and Ukraine. However, as we step into 2023, we're seeing inflation start to slow down and lower. So in December, the rate was 6.5%. So that's optimistic. And as we move into 2023, there's hopefully going to be less focus of the Fed on inflation and maybe move to wage growth because they're starting to see the trend that they want.
Yeah, so the government definitely really wanted to put the kibosh on inflation because it is not a good thing long term. And, when we look at inflation, the government really only has one tool, and that tool is interest rates. So one of the things the Fed has done is they have raised rates actually the most in history in the shortest amount of time. I think from 0 to about 4.5% in less than a year. And it is starting to have the desired impact. The Fed is really trying to crush or reduce demand. If we can reduce demand and then supply can stay constant or catch up, then maybe we'll start to see prices, level out, fall, and get back to more of the way we were. So one of the things the Fed has done is by raising interest rates, things are starting to slow, especially those things that are interest rate sensitive, housing, car purchases, credit cards, loans, corporate borrowing. So as the interest rates rise, it costs more money to purchase these things, thus diminishing demand. So what you'll see here is, well, what kind of is a normal interest rate? Well, way back in the 70s, interest rates got as high as 20% when Paul Volcker was trying to really bring down the recession that we saw back, or I'm sorry, the inflation we saw high double digits back in the late 70s and early 80s. And then every time we've had a recession, what you'll see is the interest rates gradually have continued to come down, all the way down to after the financial crisis. Interest rates got to zero. And basically savers were penalized because if you had money and you put it in the bank, you basically earned nothing. And you were forced to take risks if you wanted any kind of return. Gradually, rates started to creep up, and then we had the pandemic, and rates went all the way back to zero because we'd never had a pandemic, well, at least not in a long time, and we had to stimulate the economy to work our way through that. So now rates are back up to about 4.5% on the Fed funds rate. My guess is the Fed is going to raise rates again here at the beginning of the month, probably one more time after that. And then maybe the Fed will actually say, hey, you know what, maybe this is where I'm going to pause and stay put. So the future of interest rates, I think, is that we're probably near the peak, maybe another 0.5% from here, maybe 0.75% from here. Kind of depends on how, the rest of the economy cools off and supply catches up. So interest rates have an impact on housing. And one of the things that I've learned over the years is that housing is often the thing that gets you into a recession, and it's the thing that gets you out. Obviously, it's one of the biggest assets many people have in this country. So when the value of their home, declines, they're not so happy. So Steve, with higher interest rates, do you think we're going to have a housing correction, a housing depression, or just maybe a housing recession? What's going on?
So let's go back to last year. So last year we saw 30-year mortgage rates spike all the way up to 7% when they had been hovering around 3% for much of the last couple of years. And that, coupled with a boom in prices over the last few years, led to a housing market that was as unaffordable as it's been since any time before the housing crash in 2008. And when you hear 2008, a lot of emotions come up, and so we get a lot of questions about are we going into another 2008 style housing market? To me, I don't believe that's true. In 2008, we saw a lot of no income, no job loans, liar loans, or people carrying 3-4 mortgages at the same time. This time around, home buyers have been much more vetted. The average credit rating of a home buyer since 2008 has gone up substantially. So I don't think we're going into a 2008 style housing market where you'll see a lot of defaults or foreclosures. The other thing I like to point to is a very positive demographic trend. I just turned 40 years old, and I am considered a millennial. Actually, I'm a geriatric millennial because I'm on the older end of the millennial spectrum. But there are 72 million millennials in the United States. And so what that means is that if you look back at history, about 2/3 of those, or about 50 million of them, are going to want to become homeowners at some point in the future. So we've got another 10 or 20 years of that millennial generation who are going to want to jump into the housing market at some point. So as rates have risen, I think now rates are falling back down. We're closer to 6% now. I think there's a lot of millennials who are on the sideline who are saying, look, I'm just going to go in. I'm going to try to get in as soon as I can. And if I get a chance down the road, then I'll refinance. But there's a real big demographic trend that should sustain housing for a long time to come. So I just looked at my Zillow estimate recently, and my home prices declined about 8% in value from the top. I don't really look at that top price as anything that is relevant to me, but that's where Zillow is saying that I'm at. So could we see prices fall, let's say 5, 10, 15% in some areas, California, Florida, Kerry mentioned Idaho before, as places where we had huge booms. Yeah, I could see how home prices going down into a correction territory, 10, 15%. But because of those millennials coming on and not really having the supply of housing that's necessary to to equal that demand, I think we could see that we're not going to run into a recession. You know, we have a correction in some areas, but for the most part, we're gonna skate through this one.
Yeah, so Steve, if you're a geriatric millennial, I just want you to know that I'm a baby boomer.
Yeah, there you go. Yeah.
I'm one of the last ones, I think at 60, 61 years of age. So I feel young as a baby boomer. So yeah, when you talk about the housing market, like I said, it tends to lead you in and out of recessions. The good news is, you know, there still seems to be more buyers than there is supply. That's going to keep upward pressure on prices, but it's no longer the seller's market, and it's not really a buyer's market. It's kind of an in-between. Sellers and buyers now have to come together and be realistic about the price they're going to pay for a house. You know, so one of the things that we're worried about, though, is, well, what if we do have a housing correction and it's more severe? Are we going to have a recession? Well, you know, some believe we might have already been in a recession, because in the first 2 quarters of 2022, we had 2 negative quarters of what we call GDP growth, which some would say that is the definition. I think a broader sense of that definition is no, it's not just negative growth in the economy. Got to have something more broader and substantial, like maybe higher unemployment numbers, maybe a recession in corporate investments. And so we see more of a broad-based across the board. And at this point in time, I don't think we've seen that. And I guess even if we do see some kind of a recession, I think one of the things to know is that recessions, they're not as scary as they may seem. You know, when you look at a recession, it's kind of a slight economic trough in the economic cycle. It's not a Great Depression. It's not everything coming, you know, falling apart, so to speak. And when you look at them, the chart shows here in the orange or the yellow or gold, whatever it is, that the average recession lasts about 14 months. The average economic expansion lasts about 47 months. So, you know, we spend a lot more time in expansion mode than we do in recession mode. And so, you know, if this recession that we're in today, maybe it started at the peak of the market in January of 2022. That means we're almost 13 months, you know, into this. The other thing I think is if the Fed gets close to pausing raising interest rates, which I think we are in the next, you know, 4 or 5 months, what you're likely to see is the market kind of take a sigh of relief and then, you know, move forward. Because whenever we've had these kind of downturns like we've seen this last year, the markets have a tendency to play catch up, you know, after that. So, you know, I think at the end of the day here, yeah, will we have a recession? Have we already been in one? If we do have a recession, it's the most telegraphed, communicated recession we've ever had. And it will probably be very, very light or not too significant, because it's hard to imagine we could have a severe recession when the unemployment numbers are below 4% and there are more jobs than there are people wanting to fill them. And if people are working, they're spending money, they're buying homes, they're living their life. And so, you know, if we have a recession, it's probably not going to be too substantial. But that leads us then into the next part of this conversation is, all right, if we don't know exactly what's going to happen, how do we position ourselves in portfolios going forward? And Rachel, there's been a lot of news lately on this 60-40 portfolio, and I know you're going to explain that in a second, but they're talking about maybe the 60-40 is dead, doesn't work anymore, throw it out, let's try something different. Why don't you explain that and give us some insight about 60-40?
The 60-40 is 60% stocks, 40% bonds. So we consider this a balanced allocation, and it's pretty prudent for most people who are retired. However, 2022 is a pretty unordinary year. We had volatile interest rates, volatile inflation, and when the stocks and the equity market went down, the bonds weren't there to support the portfolio. So they were actually correlated when they really should be uncorrelated. So 2022 actually ended up being the 3rd worst performing year for the 60-40. So you can see here that it was down 18% in 2022. However, the worst years were the Great Depression in 1931 at 27%. And then in 1937, it was down 20%. So yeah, we've talked about it even in previous outlooks. Does the 60-40 make sense? And for a time there, 70-30 made sense. We needed to push a little bit more into equities because the bonds weren't making that return. And during that time, we actually did make some of those adjustments. Now, as we step into 2023, we are actually seeing a return in bonds. So now you could have 40% of your portfolio earning 5%, And then now you've just boosted your return by 2%. So I'd say we're optimistic about the 60-40 moving forward. And even though we do have years of blips like this, on average, the annual 60-40 portfolio since 1926 has earned 9%. So even though we have some of these down years, in the long run, it's still a good financial plan. And even if we have to make tweaks along the way to adjust for, a decade of lost bonds, we will do that. But it's something that we wouldn't necessarily just fully give up on. And I would say as financial planners, we now are loving the fact that, hey, bonds are actually returning something, because it's better for your portfolio that we can have a portion of it in a less volatile asset, earning you some income to help make your retirement plan work.
The 60-40 portfolio, to me, it's like getting the flu shot, right? Get the flu shot to hopefully prevent from getting a cold, and you do that, and all of a sudden one year you get a cold. Well, you still know it's good practice to keep taking the flu shot, and all of a sudden, abandoned that entirely. And I think the 60-40 allocation is like that. And from this point forward, 60-40 looks even smarter, because again, as you said, the 40% in bonds will now actually earn a higher return than what we've seen in the last 12 or 15 years, when basically interest rates were, at bottom basement, levels. So let's talk about the stock allocation. So the 60% in stocks, Steve, how do we think about stocks? Where are valuations, and what might we anticipate, in the year ahead?
Sure. Yeah, I mean, the one thing we get questions on now is, okay, now that bonds are yielding something or have a pretty good yield, maybe I should just move more of my money into bonds, or move all my money into bonds. Well, let's just look at January as a gauge there. We're already up 4.5% for January, which means that you've already earned what you will earn in your yield in bonds in 1 month. So a good month or even a good week in stocks can match the returns that you might expect in bonds right now. The other thing to know is that stocks are a much better hedge against inflation in the long run. Bonds are kind of beholden to what their interest rate are, and if we think inflation may stay elevated at 3 or 4 or 5% over the next couple of years, stocks have a better way to hedge against that inflation. A stock is an investment in a company, and companies can go out and raise their prices to continue to have better earnings, which is a hedge against that inflation. So let's talk about what we did last year. Last year, we tilted portfolios towards value and small caps, two areas that were a lot less affected by the rise in interest rates. And so that definitely helped us kind of stave off that 18% down, but it was still a rough year. So now going into this year, what are we doing? We're thinking a lot more about international stocks. Last year, the dollar may have peaked sometime, and so as the dollar falls, international stocks have a better tailwind for returns in the future. If the dollar is rising, it's a definite hindrance on international stocks. So maybe finally international stocks will be the place to be in the next couple of years, as they've been undervalued for a long time. And when I talk about like the moves that we're making, just remember, we're not making huge bets one way or the other. We might be tilting portfolios 1 or 2%. We might tilt portfolios, 5% more to equities or something like that. We're not making big giant swings. We're not going from 60-40 and then pushing you all the way down to maybe 20% stocks, or pushing you all the way up to 90% stocks. We're going to stick right around that 60-40 allocation and just tweak around the edges to hopefully get better returns over time.
Great. Thank you, Steve. Yeah, I mean, who wouldn't be happy with a 9% return over time when you look at that 60-40 portfolio? Of course, if it was that easy and it worked all the time, wouldn't that be great? So, one of the things we get when we start talking with retirees, they'll always ask, well, hey, Kerry, how much can I draw out of my portfolio? I want to have a high confidence level. I'm not going to run out of money. Because what we think about is, well, how do we have to allocate between stocks and bonds so that we can get a return that then will provide us with the income stream that will last our lifetime? And a little bit about retiring and when you retire is about luck. So let's say you retired in 1983 and you started drawing money out of your portfolio. Well, you know what? 83 was the beginning of the biggest bull market in history. Let's say you retired in 2007 at the top of the peak of the financial crisis, only to be hammered in 2008 and 9. Boy, the sequence of returns can really make a big difference, in the longevity of your retirement plan. So when we think 60-40, we're talking about allocating 60% to stocks, 40% to bonds. And, the math really hasn't changed much. Today, a 4% figure is probably a prudent number. So if you had $1 million, you can probably prudently pull 40 grand a year off of it, 4%, and have a high probability of never running out of money based on history. Now, I think you could even pull a little bit more if you had flexible, maybe withdrawal strategy. In other words, you can kind of evaluate in time the things that you need to do in your life. In other words, maybe you're planning a trip to Europe, but the economy is in a recession, markets are way down. You might say, well, you know what, I'm not going to take it this year. I'm going to wait till next year when things get a little bit better. Or if you have to paint the bathroom or do some remodeling, the best time to take money from a portfolio is when you feel really, really smart and everything is good, like January 2022. So kind of anticipating your timing of these needs that you have to live your life and to do the things that you want to. But again, think in terms of, between 3.5% and 4.5%. Obviously, if you're 70 when you retire, you can take more because your life expectancy is less. If you retire as I think what was the term, a geriatric millennial, you're only 40, well, then you might better take 2% because you got a long life expectancy ahead of you. So yeah, reasonable withdrawal rates, try to be flexible about when and how and dynamic, I guess, when you take your money. But then people lately, Steve, have been calling us about, hey, Kerry, I got some cash. What do I do with my cash? We're finally starting to see, you can earn something on your bank accounts. What's your thoughts there?
Yeah, it's true. I mean, like you said earlier, it might have been bad news last year for investors and borrowers, but for savers, it was a big help, a big relief for them. So for people who don't have a huge risk appetite, there are a couple of different ways to boost your interest at the moment. First, you can go and find a high yield savings account like a Marcus account. I have one. It's paying currently about 3.3%. You could purchase money market mutual funds, and they pay around 4% right now. And you could buy short-term CDs or treasuries, and those are yielding around 4.5%. So, some really good interest rates in places where we haven't been able to talk about them for a long, long time. The other question we've received a lot recently is about I-bonds. I-bonds, a few things to know about them. First, you can only purchase $10,000 as an individual, so a husband and wife can purchase a maximum of $20,000 worth. You'll get an interest rate for 6 months. So right now that interest rate is 6.9%, and then you'll earn that for 6 months. The interest rate will change, and you'll earn the new interest rate for the next 6-month period. You need to know that you have to hold them for at least 1 year, and if you sell them before a 5-year holding period, you'll lose 3 months of interest. The other thing I love to talk about right now, being younger, is that if you do have a little bit more appetite for risk, right now is a great time to invest in stocks. Stocks do not go on sale as very often, as you saw from Kerry's recession chart. If we did just have that recession, you can expect maybe four years of a pretty good market. So now is the time to strike while the iron's hot when it comes to stocks.
Yeah. And I think we talked, every past recession, as we look back, of course, is viewed as a buying opportunity. Oh, man, I wish I had put more money in the crash of 2000 or, 2008 or 9. But of course, every recession you're living in, you're scared to death. So Rachel, as we deal with the volatility, a lot of the news and the media coming out about, whether it's politics or, today it's about the government budget and the deficits and shutting down the government. What should investors do now? And some of the people on the call might be already retired, but maybe they have family and children and grandchildren. What should they be doing?
Yeah, so we've had people call in who are still working, contributing to a 401k, but said, oh, I had to stop. Like, I just couldn't take it anymore. I was losing money when I was contributing. So I stopped my contributions. Well, that's the worst thing that you can be doing, because you're buying more shares because everything's been discounted. So we never run away from a sale at at the Gap or whatever clothing store, but for some reason we run away from a sale in the market. And the worst thing that you can do is do that. So if you're contributing to a 401k or your IRA, just keep doing that dollar cost average into the market, and don't try to time the market, because that's something else that we hear. And we don't want you to time the market because it's hard to do it once and then it's impossible to do it again. And usually the best days are followed by the worst days. So you experience this pain, you want to pull out, but then quickly the market starts to recover. So this chart shows that even if you just miss 10 of the best days in a 20-year period, your returns go from 5.6% to 2%. And if you keep going down and down, you'll see that the more you miss, your return turns negative. So the best thing that you can do is just stay invested and ride through it. So right now, if you are contributing, that's a great time to do it. If you're retired, like Kerry had mentioned, just remind your children, your grandchildren, that this is an opportunity for them. And then for you, if you do have some cash on the sideline, or you're willing to make a few, tweaks, consider putting a little bit more into stocks and take this as that opportunity. Just because you're not receiving an income like from a job doesn't mean you can't do things to use this as an opportunity.
Yeah, and I think back in January, the market peaked a little over 4,600 or so. I think it bottomed out at 3,300 in, I think, October. Today we're around a little under 4,000, I believe, as we're taping this. We're still 15% away from where the market was. So like you said, whenever we've had some pretty bad downturns, there's usually some pretty big upturns.
Well, and the other thing is people want to I'll get back in when I feel better, when I know things are going to be better. Well, by that time, it's usually too late. You've missed all the opportunity. You've sold low and now you're buying high. And that's the complete opposite of what we want people to be doing.
Right. So I guess that kind of goes in our next thing is behavior. How people behave is really going to determine a lot to do with what kind of return they earn, right? Because if you're letting sound bites and negativity kind of run your emotions, you might be doing things that might be in jeopardy or jeopardizing your long-term financial future. So let's talk about some of the behavioral things that people do that maybe they need to be aware of so that they could maybe overcome some of those challenges.
Yeah, so your brain can be your best friend and also your worst enemy. I think it can trick you into doing some silly, irrational things. And we have a few biases that we see typically in finance. So if you're just aware of them, then you can focus on controlling them and maybe making new decisions. So the one that we always see first is herd mentality, or FOMO. That's the fear of missing out. So you're just following what everybody else is doing because you want to be a part of it. You don't want to miss out on that opportunity. However, this might not always be the opportunity that's right for you. So you need to ask yourself, why are they doing it? And is this right for my long-term plan? And if you don't understand the fundamentals or why people are doing something or what it is, then that's a red flag that you really shouldn't get into it. Seek outside counselor or try to get an understanding of it before you make that investment choice. The other thing that we see a lot is the emotional gap. So this is making decisions out of fear, anxiety, excitement even. And, when was the last time you made a good decision out of fear? Not very often. For myself, my judgment is blurred and I'm irrational. So an example of this is what we've been seeing for a lot of people making decisions about their portfolio because of the political climate, who's in office, who's not in office. And I could show you so many charts that represent and explain why it doesn't matter who's in the office in the long run. You still want to remain invested, but you're still going to respond based on your fear. And remember, let's go back to that chart of the S&P or the 60-40 portfolio. Since 1926, you earned 9%. You know how many different parties were in office then? I mean, we have seen so many. And I think at that time, there was a point where the Republicans were the Democrats, Democrats were Republicans. So, and it's okay, you still earn 9%. So, try to avoid making decisions off of that. Get out of your echo chamber, seek a different opinion or just perspective, and then make a decision. Then there's anchoring. So this is using irrelevant information like the stock price that you purchased it at, or for a lot of our clients, my portfolio value as of January 2022. And then we use this irrelevant information as a benchmark to make future decisions with our portfolio. And it doesn't matter if we have new information that should really be used to make decisions. We still anchor on these numbers and our judgment is skewed. So my best advice is just don't memorialize those values, don't write them down, just take a look and try to forget it. And then there's overconfidence. So this is where you do one thing right and then you think you can do it right the rest of the time. So this comes back to even market timing. or even stock picking. For myself, I picked one really good stock a couple years ago, and I did great. And from then I picked a few others thinking that I could replicate what I did before. I haven't replicated that first one. So I've learned that, a lot of that first choice was based on luck and some other external factors. I can't get it right every time. And so I need to find a new approach to making some of these decisions. So be humble, learn from your mistakes, and it's going to benefit you long term. Ultimately, all these biases are really hard to overcome, but just being aware of it at least gets you to stop, pause, think about your decision. And then that's also why we are here. So we're here to be that objective viewpoint, help you get out of your echo chamber and hear something new to help you make some decisions.
Okay, well, thanks, Rachel. Hey, do you have any hot stock tips?
Yeah.
I'm kidding. Yeah, please, keep them for yourself. Right. Yeah, so that was great. And, really what we want to do is kind of sum it up today with maybe some key takeaways. And, some of the key takeaways that I see is the first one is kind of goes with anchoring. People remember their highest number. Markets go down. They say, hey, Kerry, I lost 100,000 or 50,000 or 200. And it's like, well, the only reason you saw that higher value is because what we invested in. It's also more of a reflection of volatility, not that you lost something. So here's a chart. We show it all the time. I don't know if you can read exactly all the numbers, but basically what you'll see is just a bunch of gray bars going across the top. And that's all the years the markets were positive, going all the way back to about 1980. So the markets were positive about 33 years. And on the bottom part of the chart, you'll see the times the markets were negative. So that was about 9 times. So I have about 42 years, 33 positive, 9 negative. So obviously we have a lot of more better years than we have bad. But in the big gold circle, it shows the average return if you'd have just, forgot about it, went about your business, went to the park, lived your life, enjoyed the grandkids, whatever, and you would have averaged about 11.5%. Who wouldn't be happy with 11.5? And then also, to get the 11.5, you got to live with a little bit of pain. And that pain is called volatility. Volatility is not a loss unless you behave maybe improperly and use the downturn to sell. But if you would learn and just kind of prepare for volatility, and it's averaged about 14% intra-year, you know what, we're going to get through this. So, it's best sometimes to, like I said, volatility is not your enemy. It gives you opportunities if you're young and you accumulate more shares when prices are down. And then, Steve, I think you did some math on that chart.
Yeah, I looked at all the years that the market was down at least 15%, and it was 16 times over those 42 years. So 40% of all years. So you better expect over your lifetime to every two out of every 5 years, you're going to have to live with those downturns. So you just got to get comfortable with them, find a risk profile that fits you, and just live through that volatility. The more you can live through it, the better your life will be.
Yeah, so the sooner you accept it, probably the happier you'll be, right? And just kind of move on with your life. Yeah, and I think one of the things we talked a little bit about, the biases is remove maybe some of the importance people place on politics. The markets is not politically sensitive. It's neither Republican or Democrat. It's an economic system of stocks. And, we've had both kinds of, Democrats, Republicans, and I remember the last couple of cycles here, as soon as President Trump was elected, I had people call me up and say, Kerry, get me out. This guy's a weirdo. And then when Biden got in, and the other half of the people called me out and said, hey, this guy's a weirdo. We're a divided nation, but at the end of the day, politics don't really drive the market. Yeah, it might have some influences, but it's more about the economic cycle and where we are. And another one is stay diversified. Diversification really makes sense. You can't predict the market. Even in the last day or two, I'm reading all kinds of different things where, we're going to have a really bad recession and these tech stocks are going down big and whatnot. And then others, earnings aren't so bad. And, we're having a economic earnings maybe slow down, maybe a slight recession in earnings, but not a depression. And then I think you say, what's your favorite saying about diversification?
Yeah, diversification is accepting good while avoiding terrible, but you miss out on great.
Right. Yeah. And then I think get rich quick schemes. A lot of people bought into the Robinhood and the cryptocurrencies and these hot meme stocks and whatnot. And I think for investors, the sooner you realize there is no quick get rich quick scheme, and you just kind of buckle down and you do the hard work, you'll get there. I think Warren Buffett made most of his money after he was age 65. I know, of course, a lot of us would like to make that faster, right? But again, probably not going to happen for most of us. And then I always say time heals all wounds. And Steve, we always get a people or two chiming in. Well, Kerry, I don't have time. So what did you find out about time?
Yeah, I don't have time to recover from this is something you should leave off of your vocabulary, because I looked at it. If you're a 65-year-old married couple, there is a 50% chance that one of you is going to live to 90 years old. So there is a 25-year investing horizon for a 65-year-old married couple. So you definitely have time to recover.
Yeah. Well, and like I said, recessions don't last that long, 14 months, right?
Mhm.
And I guess to some degree, if our life expectancy is that short, it really won't matter. We'll be dead. So anyway, well, that's all we have to say today. Thank you guys for tuning in. If you have any questions, please email or reach out to your financial advisor. Be on the lookout for upcoming events. We're going to be doing a few webinars in March and April, and then another economic outlook in the month of July 2023 after the end of the second half. So anybody have anything else? And thank you and have a great day. Rachel, Steve?
No, that's it. Thank you, everybody.
Thanks, everybody.
Bye.